Hello, my name is Ross Kent. I'm the head of the Institutional Client Group at NAB Asset Management. And joining me this afternoon is Dr Tano Pelosi from the Antares Fixed Income team. Welcome, Tano.
Thank you, Ross.
Tano, we spoke probably 6 months ago, and at the time you were foreshadowing a fairly bumpy ride through 2018. Looking through the lens of the year to date, how's it going?
As you say, pretty much as we expected. So we're seeing an increase in the bouts of volatility, but not only that, the volatility is actually becoming more pronounced, more magnified. And there's several reasons for that, which we can go through this afternoon. But one of the key ones is that we're seeing a tightening of financial conditions as a result of withdrawal of central bank liquidity.
This reference to liquidity, we hear about it a lot, it's referred to a lot. In really practical terms, what are the biggest changes? For example, when you're thinking about setting the portfolios to be more resilient without liquidity?
Sure. So the biggest change over the last few years has been quantitative easing. So if you think about all the accommodation central banks have provided, not only by lowering official interest rates, they got to the zero bound, they had to do a lot more to sort of solve the problems in the economies worldwide. And what that effectively meant was they had to essentially grow the size of their balance sheets by buying assets, predominantly bonds. It's happened across most jurisdictions. And what happens effectively is as they buy the bonds, they're driving the risk-free rate down and at the same time driving risk premiums lower. So essentially it's a liquidity effect that's driving up asset valuations. It's been one of the predominant sort of drivers of asset valuations over the last 10 years.
And so I imagine that as a result of that, if you like, that liquidity tailwind being withdrawn somewhat, perhaps portfolios that have been more reliant on the carry trade might be a little more exposed at the moment?
That is true, mainly because firstly you're seeing an increase in volatility and that challenges the sort of Goldilocks inspired carry trades, if you will, but also because where we are in the cycle. So arguably the US is now in a late cycle, therefore the trade-offs between growth and inflation become a little bit more pronounced, which gives central banks like the Fed and to that extent the ECB, I would add, less scope to pull back on stimulus, or sorry, withdrawal of stimulus, or what we're calling quantitative tightening. And that was really the story of the last few years. Every time there was a hiccup in financial markets, essentially the central banks had your back by walking back rate expectations, by essentially providing more accommodation. They have less scope to do that going forward.
So from the portfolio management perspective, what are the considerations that are uppermost in your mind?
Well, what we now have is a situation that becomes a little bit more binary. It's as I say, it's certainly not Goldilocks anymore in our view. You have increasing bouts of volatility. You have these trade-offs between growth and inflation, and so inflation risks are percolating upwards, which of course has broader ramifications for risk assets, including credit. And at the same time, I think what we're seeing is the rise of geopolitical risks, call it trade wars, emerging market crises, what's going on with North Korea and the US. So these now they come really to the fore in a way they haven't in the past because of that essentially that central bank put that was in place. That central bank put is no longer there in our view. Therefore, the markets are left very much to their own devices. So what does that argue for from a portfolio standpoint? It argues for thinking more about liquidity, diversification, and taking out sort of cost-effective hedges where it makes sense.
And just on that point around hedging, you've made reference to the potentially enlarged inflation risks. In your own mind, where are perhaps the opportunities to enhance portfos with some inflation protection?
Yeah, so I wouldn't rule out carry trades altogether. I think they still have a role to play. I think it becomes synonymous with credit risk. So we would still look to take good quality credit risk in as liquid a form as we can. But we'd also think about taking out some sort of inflation protection where portfolios can do that, particularly given that inflation risks these days tend to be more global in nature. So if you wanted to continue to participate in the credit story, and I think there's still good reasons to do that, particularly in the shorter end of curve, so short duration credit, but also coupled with some protection from real rates. essentially it's a soft long, we think of in those terms. So you're taking out protection through longer duration real assets that will give you some cover if there was an inflation surprise, which clearly would, in our view, have some negative spillover effects for credit and other risk assets. So this is the sort of hedging we're talking about.
Tano, as ever, a very lucid explanation of the portfolio conditions we're facing at the moment. I wish you good luck for the balance of this year, and thanks again for joining us this afternoon.
Thank you, Ross. It was my pleasure.